Hello, everyone. Thank you so much for joining us again on Safe Money Radio. Now, if you haven't been listening for very long, you may not know that we also have a podcast of the show. And so a lot of times you may hear us on the radio, but you could also watch this just by going to YouTube. We're also on Apple and Spotify and all the places where you get your podcasts. But today's a very special episode, so if you're listening, you might want to go to YouTube later and actually have the opportunity to watch this, because there's going to be a lot of information packed into this show today. We have a returning guest. I call her Sis. She's like a sister to me. We've got Heather Schreiber with us from near Atlanta, Georgia. So Heather, thank you so much for joining us on the show again.
Thanks, Brad. It's always great to be here.
Well, listen, Heather, we're going to do something different at the beginning, because I think I've learned over the last few years, I have so many guests on the show, and I know everyone really well, but our listeners don't necessarily know everyone as well as I do. And we're all friends and colleagues, and so I take that for granted. And so, this year I've already had Tom Hegna on the show. I've had Dr. Wade Fowle on the show. You're on today. Ed Slott's going to be on in a couple of days. And again, I take it for granted that everyone knows you guys like I do. So here's what I want to do. I want to put you on the spot and have you do what no one likes to do. I want you to talk about yourself. So for all of our listeners, tell everyone a little bit about who you are and what it is that you do in your business.
Okay. I do, it's hard to explain what I do sometimes to the average listener, but I've spent my entire career, 30 years, kind of navigating retirement income planning. That's my passion. So my clients are financial professionals and tax advisors. That's really who my clients are. So they're not the end, the consumer. So Brad, you and I are partners. And so I really work to help keep everyone abreast of all of the evolution of tax law changes. We know that it changes by the minute. Sometimes we're constantly waiting for clarification or guidance on tax law changes that have come out that require additional guidance. Social Security planning happens to be one of my greatest areas of passion, because it is such a critical source of income for most retirees. And it's one of the most misunderstood. It has a lot of complexity to it. It needs to be done right. There's a hiring freeze at Social Security. And so, that is one of the pivotal points of a retirement income plan. So, of course, that is one of the areas that I focus on, and Medicare. But anyway, that's what I do. I'm a consumer advocate by my nature. I love helping people, as you do. And so that's why we work well together. So in a nutshell, that's kind of what I do. I kind of keep abreast of all of the rules and regulations with respect to IRA planning and legacy planning and Social Security and Medicare, and make sure that we're making the right decisions as we navigate from working to retirement.
Fantastic. And for those of you who are listening or watching right now, I'll just tell you this. I have a lot of guests on the show, but the videos that I do with Heather have more views than anyone else. Like, we've done stuff on Social Security and just asking one question, like, when should I trigger Social Security, or when is the break-even point? That video's been viewed like 25,000 times. I haven't even looked in like 6 months, but it's crazy how many people want to know this information. So it's so good to have a fellow retirement income certified professional on the show with us today. She's also a national Social Security expert who speaks all over the country. It's hard for me. I'll text her. I'm like, where are you today? And she'll be somewhere halfway around the world. So it's good to have Heather with us on the show. And for those of you who are listening, before we take our first break, I want to tell you this. Here's why this show is going to be really unique. Now, I'm going to throw a lot of numbers at you, but I'm doing that because I want you to stay with us. Today's show is key retirement planning ages that you need to remember. So we're going to be talking about specific ages during your life that go hand in hand with special things that can happen regarding your retirement planning. So we're going to be talking about what happens at age 55, age 59 and a half, age 62, age 63, age 65, age 67, age 70 and a half, age 73, and age 75. And don't be overwhelmed with it. If you're the average person listening right now, you're like, what in the world do all those numbers mean? What are those? Why are those ages important? Well, I had the opportunity to sit in on one of Heather's classes that she was teaching in Colorado in 2024. And when I heard it, I thought, why in the world have we never done a show about this? So here we are. So stay with us today. We'll be back right after this break, and we're going to jump into all these key ages that you need to know and remember for retirement planning. And just know this, at any time, If you ever want our free information, you can always call us at 866-780-SAFE. That's 866-780-7233. And if you're watching this on YouTube, we're going to have information online for how you can reach out to Heather and connect with her. That will be in the description below this video on YouTube. So 866-780-7233. You can call us at any time. Heather, let's start with the first one that I almost didn't include in the show, but I thought this really affects a lot of people and they don't realize it. So let's take age 55. Why is age 55 a key age to remember when it comes to retirement planning?
Well, can I back you up even further and start with age 50? Age 50.
Absolutely.
Let me just mention age 50 because that's an age where you get the age 50 catch-ups, and it's an opportunity to save more. And we know that people aren't saving enough, right? And so I just want to mention that age 50, you have the ability to contribute more to your IRA, your qualified plans, your simple plan. So I just want to mention that. Age 50 is also an age for Social Security. And you think, what about 50? At 50, you might see an opportunity where if you were disabled and you are collecting disability benefits and your spouse passes away, normally, we'll get to that. Normally, at 60 is the earliest age you can collect survivor benefits. But if you're disabled and your spouse passes away, you can switch over to a higher survivor benefit as early as age 50 if you were disabled at the point of your spouse's death, or you become disabled within 7 years of their death. So those are two things that happen at age 50 that I just wanted to bring up quickly before we got to age 55.
Very good. And I'll piggyback on that because we just had a client in this week. And this happens a lot of times. They'll call into the show and they're like, hey, Brad, I'm way behind the 8 ball. I'm starting way too late in life. I'm 52. I've never saved anything. What should I do? So we talked about the Roth and why he would want to max fund a Roth contribution instead of an IRA. And he said, so that's $6,500, right? And of course, we've got the catch-up contribution. And I kind of laugh about being able to catch up because we're behind is a whole whopping $1,000.
Right.
But we do get that $1,000. And then when it comes to simple plans, it's more. So that's a great thing. So thank you so much. And guys, now you're seeing why we have her on the show. So age 50, a key year to remember. And now let's step on to age 55.
Yeah, so age 55 is a critical year because we're going to get to 59 and a half when typically most people know that 59 and a half is an important year. That seems to be the age that everyone knows that you're not going to pay a 10% penalty anymore if you take a distribution from a retirement plan. But 55 is one that is often missed by most financial professionals. They say, what happens at 55 that's so instrumental? Well, if you're someone who separates from service for any reason, let's suppose that you have been laid off from a job or you leave a job prematurely, whatever the case may be, and you're at least 55. So you're somewhere between 55 and 59, but not yet 59 and a half. And you have a qualified plan. So your employer, the one that you've just left, you've got a qualified plan. Now, I'm not talking a SEP or a simple IRA. Those don't count. But if you're in something like a 403B, a 401k, something like that, and you have at least reached 55 in the same calendar year that you have separated. So you might be 54. Let's suppose I just lost my job today and I'm only 54, but I will be 55 by the end of this plan or this calendar year. So I have to meet both conditions in the same year, that I can take money directly out of that plan and not pay the 10% penalty. But if I roll it into an IRA, I lose that exception. So it's called the separate age 55 exception. People call it different things. Why it's important is because a lot of people don't know it. And they say, well, oh my gosh, I've lost my job. I might need some temporary income to bridge me until I get another job. Or let's say, well, I'm 58. I don't plan on I'm going to take early retirement, but I still might need income from this 401k. So then you take enough out of the plan directly to yourself. I'm 58. I cannot take money out of my IRA without a 10% penalty because I don't have an exception. I'm not yet 59 and a half. So I'm going to take money out of this 401k directly and then roll the rest. So figure out how much I need from now until 59 and a half, take that out of my 401k. Yes, I'm going to pay ordinary income tax on the distribution, but I'm going to avoid the 10% penalty. People miss it all the time. Now, you also have to recognize that if you do that, if you take money directly out of a 401k or any type of qualified plan like that, that is eligible for rollover, then what does the plan do? Many of you know they'll withhold 20%. Any eligible rollover distribution is always going to be required. The IRS requires a 20% mandatory withholding. I say that isn't necessarily a bad thing because you're going to have to pay ordinary income tax on it anyway. So just be mindful that when you're doing that type of planning and figuring out how much do I need to get me through, if I need this money out of the 401k to bridge me until 59.5, how much do I need to get me through? You got to figure out that they're going to net it for taxes. You're only going to get 80%, and you'll have that 20% waiting for you at tax time as a credit toward the taxes. But people miss it. They want to start doing substantially equal periodic payments, if you're familiar with 72T payments, and often that isn't needed. So make sure that you're working with a reputable advisor that understands these rules and knows that there's ways around it. If it falls, in that situation. Now, if you're 53 when you retire or lose your job, you can't just wait until 55 to use this rule. You have to simultaneously meet both conditions. But it's an opportunity that many people miss, and they panic and they say, "Oh my gosh, I'm just going to roll it over and I'll take the distribution from there. I'll pay the 10% penalty." So make sure that you're exploring your options before you do that. The age 55 rule, again, only applies to qualified plans and only from the employer that you separated and that plan.
Heather, this is such good information. So I want to just add one thing, because this happens all the time. People listen all over the country. We've got clients in like 15 states, and someone will call in and they'll be 57 years old and they will have separated after age 55, and they'll call in and hear something like this and say, "Can you help me with this? I separated after the age of 55. But here's what we learn so much of the time. And we want all of our listeners to know this. Advisors are trained to hear about opportunities when they can move your money out of the plan it's in over to something that they can manage for you. So much of the time, if you've gone to a dinner seminar or you've heard something on the radio or you watch something on YouTube and then you talk to an advisor, it may be that they've already rolled you out of that plan into an IRA so they can help manage those assets they wanted out of that company plan, and then you're stuck in it. If you've rolled it, like Heather said, from the 401k to an IRA, the age 55 exception does not work then. So here's what I would always say, just like Ed Slott will say: when someone dies, touch nothing. That's what he says, until you've talked to a retirement income professional. If you've separated from service in the year in which you're going to turn 55, don't move anything. Don't touch anything until you've talked to someone who knows what your best options are. Because it may be, just like Heather said, that you want to figure out the right formula and the right numbers to take a distribution to yourself first, and then, sure, it may be okay to roll over the rest into an IRA, but maybe not. It depends on what your income needs are going to be between age 55 and age 59.5. And in order to leave it available, it's got to stay in the company plan. So, such great information. And don't get overwhelmed. Throughout the show, I'm going to give you a phone number to call at any time. You can call in and ask for a free consultation. You can go to this podcast on YouTube. You can look for Heather's information. Our number is 866-780-7233. And now we're going to segue into another, keeping the ages in under 60, age 59.5. This is a big one. We could spend the entire show on it. I wrote almost an entire chapter in my book, Bulletproof, about age 59.5. So, Heather, jump in anywhere you want to with all the different things that can happen. But what happens when you turn 59.5?
Well, right. So the intention of retirement accounts is for retirement. So obviously, the reason that there is a penalty to take most withdrawals before 59.5, unless you meet an exception like death, disability, first-time home purchase up to $10,000, certain criteria that you have to meet, is because the whole point is to save for your retirement. So when you get to that age, that is the point at which you can take distributions from most plans. Now, certain qualified plans, if you're still working, they may or may not let you. They have to have an in-service withdrawal provision, or you might have to retire or something like that. But you're still not going to pay a 10% penalty. So when you get to 59.5, that's considered, okay, I've made it this far. Once I take a distribution, I no longer have to worry about this additional 10% early withdrawal tax in addition to ordinary income tax. So that's the magic age. Now, is that the point at which you should take it? I'd say probably not. If you're, you could be spending at that point another 30 years in retirement, and you're probably still working. I mean, people are living and working longer. So, but it is the age at which you can check that box and no longer have to worry about it. It is also the age that qualifies in the dual requirement for Roth, for tax-free Roth distributions. That's one of the qualifying events, and usually the one that people meet along with the 5-year holding period. So it's a critical age that you can say, okay, I've gotten to the place. I finally can get, if I need money out of my qualified plans, I know that I don't have to pay this 10% penalty anymore.
That's right. And it's also a great planning age from this perspective, that inside a 401k or a 403b, often you have very limited choices inside the plan option. So very few things to invest in, not a lot of diversity, and a lot of times almost no safety inside it, just maybe sitting in money market for 0.5%. But when there is an age 59 and a half withdrawal exception there, and Heather talked about this, most people know it as an age 59 and a half withdrawal. It's also called an in-service withdrawal. But when the company plan allows it, this is the beauty to it. Say you have $500,000 in your company plan, in your 401k. You can leave $400,000 in there if you want to and roll out $100,000 of it. Or you could take out every single penny of it. If you're done with risk and you realize you're too close to retirement to take on that risk, you can roll the entire amount out and do a rollover to an IRA. Give you a whole lot more options, safety, income riders, all kinds of things, the whole spectrum. But it doesn't close your company plan. It's still open, and so your next paycheck, you can still do your payroll, contributions in, you'll still get your company match. It leaves it open. So there's just so many options that are there, avoiding the 10% penalties, being able to take distributions without 20% withholdings if you do rollovers, and just all kinds of things. So
yeah, that's a very common question I get among financial professionals. Clients say, I really don't maybe necessarily want to have the exact holdings that are in my 401k, and I would like to diversify or put it somewhere over here and have more choices. I always say, if your client has a 401k and they're under 59 and a half, forget about it, because most plans, first of all, the plan has to allow for what's called a non-hardship in-service withdrawal provision. And they're usually not going to allow one before 59 and a half, because what's odd, it always seemed the opposite of what it defies logic to me, because under tax law, elected deferrals, the portion that the employee puts in on their own behalf that they contribute, isn't permitted to come out while a person's working until they're 59 and a half. However, the employer match and rollover dollars can come in before 50 or come out before 59 and a half. It's weird. You would think that our own contributions can come out, but it can't. So I would say don't bother really going to look for an in-service withdrawal provision, because most plans are usually going to require 59 and a half for in-service withdrawals. So yeah, that is a critical age. If they've made it to 59 and a half, again, the plan doesn't have to allow it, but most plans usually do for non-hardship in-service withdrawals. They don't always have to, but at least like Brad says, they can let them take it out. For hardship withdrawals, they can let the monies out before then. However, the thing with hardship withdrawals, it has to meet an immediate and unforeseeable need that they can't get the money from another source, but that can't be rolled over. And oddly enough, if they're under 59 and a half, they're going to pay the penalty for it. So it's not an eligible rollover, and they're going to pay a penalty. That's a totally different type of distribution. But 59 and a half is the critical age for, I've got money in my 401k. I've finally reached that age. Now there's a possibility that you can go back to your employer and ask if you can take any money out and perhaps roll it into an IRA to diversify or do what you need to do. Good point.
And I'll say in the Springfield area, of course, I know we have listeners all over the world, but in the Springfield area, it's about 95% of the time that the company plan will allow for an in-service withdrawal or an age 59 and a half withdrawal. So Cox, Mercy, a lot of your big companies, 3M, they all allow it. If you don't know whether or not your company allows it, you can just go to someone in HR or call the custodian. If it's Fidelity or whoever the custodian is on your statement, just call and say, do you allow for age 59 and a half withdrawals? And we're more than happy to help you do that too. We'll call with you. We know what to say. But then they'll let you know. So if you're listening right now, you're age 57, you know you're not changing jobs, but you don't like your 401k or the options that are there, and you lost a ton of money in 2022 when the market crashed, and you're like, hey, I don't want to go through this again. You need to put on the calendar age 59 and a half. And it is literally the day you turn 59, go out 6 months. It is to the day 59 and a half. That's when you become eligible for it. If you want to know more about this, listen, I've written national articles about this. There's a chapter 4 in my book, Bulletproof, the Safe and Secure Retirement Income Plan. I go into 6 reasons why you want to consider an in-service withdrawal or an age 59 and a half withdrawal. It's a key planning age. So we're going to take a quick break. If you want a free copy of the book or a free consultation, just call in anytime. It's 866-780-7233. We'll be back right after this message. More with Heather in just a minute. Okay, friends, if you're just now joining us, if you're hearing us on the radio, this is definitely a show. You want to go to YouTube and watch the podcast because we're covering key retirement planning ages. We've talked about age 50, age 55, age 59 and a half, and now we're up to age 62. And Heather has a lot of sweet spots in what she does, but this is where she really hits one of her main sweet spots. So age 62, Heather, what happens when someone turns age 62?
Well, you skipped 60.
I did. I skipped 60.
I'm going to make you go back. 60.
Okay,
So let's talk about 60 real quick, because I kind of mentioned age 50 for survivor benefits for survivors who were disabled, right? But
Correct.
The critical age for Social Security is 60 for surviving spouses. That is usually the earliest age that aged widow or widowers can collect benefits. Now, I say aged because some will collect it earlier if they're caring for a dependent child of the deceased, a child that's under the age of 16 or was disabled before the age of 22. So those might be young, right? They might collect them for an early death where they're caring for those children. But what happens is they usually age out, meaning the oldest child turns 16 and they might be in their 40s or 50s, and they have sort of this donut period where they can't collect benefits, and then they turn 60, and then they can collect what I call aged widow or widower's benefits. So 60 is usually the earliest age. If they collect as early as that, they're not going to get 100% of what the deceased spouse was collecting. They're going to get a reduction of 28.5%. That's not always a bad thing, because they might be able to switch over to their own retirement benefit as late as age 70. There's a leveraging technique there that only exists between survivor benefits and retirement benefits, in that you can collect one before the other. You want to hold out for the higher one later, and you need to work with someone that understands how to do that, because Social Security, the reps at Social Security, either by phone or in the local offices, are prohibited from giving anything that looks like advice, okay? They will not do that. So 9 times out of 10, when you go there to talk to them, they'll just tell you, well, this benefit's higher, just take that. And what they're really doing is kind of giving you a deemed filing, where they're just saying, okay, we're going to give you, if the survivor benefit's higher, well, we're going to deem you for both. We're going to give you your retirement benefit, and then we're going to add on the higher survivor. So you want to make sure you understand that. The other thing is, you may be 60 and you say, well, you go back to your financial professional, you go back to your friend and say, well, I went there. I heard Heather say I could file at 60, but they told me I couldn't get it, and I don't understand why. The other thing is that if you're working, even with survivor benefits, if you earn too much this year, that limit is $22,320. If you earn too much, then a certain amount over that, if you earn, let's say $40,000 over that, then they'll withhold half of what's over that amount. So say it's $20,000, they're going to withhold $10,000 of the benefits. So you still have to be mindful of, if you're continuing to work and if you're making a lot of money, they might say your excess income wipes out the benefit. So that's another thing. But 60 is a critical age. You need to work with someone when you're in that situation, and perhaps you're a young widow or widower that understands, and you've earned your own retirement benefit, that understands the way to leverage those benefits to maximize your income. The other thing is, for survivor benefits, if you remarry at age 60 or later, you can still collect benefits from a prior spouse that passed away, or even an ex-spouse that you were married to for 10 years or more. So that's what I'll say about 60. Those are my important things. 62. Good. What's important about 62? Well, we all know, or most of us, that 62 is the earliest age at which you can collect your own retirement benefit that you've earned from Social Security, or a spousal benefit. Now, with spousal benefits, the only way you're going to collect a spousal benefit is if it produces a greater benefit than your own, or once your spouse files. So rules have changed over the years. Believe it or not, it's been 9 years since these rules changed and drove everybody upside down, and people are still confused by it. But the thing you need to understand is, if you're a dependent spouse, meaning someone that perhaps has a very low benefit or never earned the credits, the 40 credits that are required, your spouse, I'll call your working spouse, must file for benefits before you can ever claim a benefit under their record. That is standard operating procedure forever, okay? That's the way the rules are now. But 62 is the earliest age. So should we claim at 62? It depends. I mean, I look at a lot of things. When you work with me, I ask lots of questions. It depends on your ages. You know, if you're a married couple, there's a wide disparity in ages, and the lower and the younger spouse has a very low benefit, I might say go ahead and trigger it at 62. You've got the lower benefit, your spouse is higher benefit. You're going to inherit the higher benefit sooner than someone's that's closer in age. Those kinds of things. But on average, the average age that people are claiming, Brad, believe it or not, is going up. The trajectory is going up. It's actually 65.2 is the average as of the 2023 statistical supplement for Social Security. So it is trending upward. I'd like to think in my heart of hearts that it's because people are getting educated by people like me. I hope so. And they're financial advisors. See, this is incredible. I mean, we could speak for hours, and we do talk about this. I'm so passionate about it. But 62 critical age, if you are a 67 full retirement age, meaning you were born in 1960 or later, that means you're taking a permanent cut of 30%. You could get 67% more if you waited till 70. So there's a huge decision to be made there. So, but 62, earliest age to file for Social Security. If you're working, I would suggest you not do that, even if you're under the earnings limit, because even if you're under the earnings limit and you're working, you're probably going to pay taxes on a portion of it. If your spouse is working and making a lot of money, you're probably going to pay taxes on it. So there's a lot of things to consider about that earliest claim age.
And what is the earnings limit for 2024 if you're filing at 62 and you're still working? What's the earnings limit?
$22,320.
Okay. So if you're making above $22,320, there's going to be the withholding formula. Maybe isn't in your best interest to do it. Now, Heather, here's another question. I know we could do 10 different questions we get on should I file at 62, but what we hear all the time, of course, people are calling, oh, Social Security's not going to be here 10 years from now. I'm taking every penny I can get right now and I'm running. When is it valid for someone to truly trigger at 62? What would be a situation where maybe it would be in their best interest to trigger at 62?
And there are, and I'm not saying, you'll never hear me say no one should do anything. I'm never going to say that because everyone is different. I'd say if you are single and if you have abbreviated, if your health is poor, of course take it. If you don't have much in other assets and you need it, of course take it. If in that example I gave, if you are the lower earning spouse, then I would say, okay, if we want, because some people say, well, I paid into it and by golly, I want it. Then I'd say, okay, well, let's have the lower earning spouse go ahead and file if we can get the higher earning spouse to at least wait until full retirement age, because we want to kind of balance things out because we're looking at lifelong cash flow for everyone, right? So we want the higher one to at least wait till full retirement age longer if we can, because we're not only looking at sustainability of joint cash flow during both lifetimes, but we're also planning for the survivor. And because that lower earning spouse is going to rely on the higher earner's decision, when one of them dies, that higher earning spouse's decision is going to impact the survivor, maybe that lower earner, right? So we're always trying to balance out those decisions. So those would be examples of why I would say go ahead and file at 62.
Very good. And then I will say one more thing. I'll throw in a bone here for my good friend, Dr. Wade Fowle, because at age 62, we had him on the show 2 weeks ago, and we did an entire show on reverse mortgages. First time we've ever done that on the show. And so at 62, that's the first age at which you can actually apply for a HECM loan. That's right. And if you have only heard negative things about that, you really should order Dr. Fowle's book online and read it. He's in his 4th edition right now. The last name is spelled P-F-A-U, Dr. Wade Fowle. It is a key opportunity to trigger tax-free income from using an asset that you've got. And we've been trained to think that Roths are the only way to have tax-free income. There's also your home. So we want to throw that in there.
I mean, that's huge. I mean, how many people have the majority of their wealth inside their home and home equity?
Asset.
I mean, really. So it's a huge asset.
You could either trigger income from a 401k that's 100% taxable, or you could let that continue to build and defer, and you could trigger income from something that's 100% tax-free. and you need to work with someone who understands all the pluses and minuses, benefits and features of maybe doing both, a combination of both or one over the other. That's why you need to work with a retirement income certified professional like myself and Heather. So let's jump into one more age before we take a quick break. Age 63, I know to a lot of people, that's going to throw them like, why is 63 an important age? And it's really important. So Heather, tell everyone why it's important.
Yeah, when I went on the road and did this presentation, they were like, that one just doesn't strike a chord. And it should. And it doesn't for a lot of people. Even tax professionals don't think about this age, but it's an age that people go, yeah, I should have thought about this age. For those folks that intend to or do enroll in Medicare at 65, they need to be thinking about what their adjusted gross income or their modified adjusted gross income looks like in the year they turn 63. And every year thereafter have to be once they're enrolled in Medicare, because Medicare premiums, for example, for 2024 are based on what Magi looks like in 2022. So you have to look at what are the things that I'm doing in the 2 years prior to the current year when I'm on Medicare, because things like Roth conversions, while really a great tool to help mitigate that risk of having too much in the pre-tax bucket, knowing that at some point in the future I'm going to be forced to take it out in the form of RMDs, they're great tools to kind of diversify that risk. If you're doing it at 63, when you plan on enrolling in Medicare at 65 and you go over certain levels in 2024, if your Magi was over 103,000, if you're single and 206,000, if you're married, you start getting into what's called premium surcharge bands. There's 5 more. And you get hit with Aunt Irma, income-related monthly adjustment amounts. And they'll hit you for a full 12-month period. And if you're married and you're both on Medicare, times 2. So it can get up to almost $600 a month instead of the standard premium, right? So it surprises people. Now, what I will say is people will say, well, wait a minute, at 65, this year, you're using my income when it was one of my highest earning years, and I've since retired. Certain life-changing events or qualifying life-changing events can be appealed. You can ask for a reconsideration of that premium based upon a more current year. And you use the life-changing event form. You do it as soon as you get your premium notice, which usually comes out in the end of October. And you send it back and say, wait a minute, I've since retired, whatever it is. Work stoppage is one of them. Give them proof from your employer saying you've retired, and use a more current year. If you retired in 2023, or 2022, you use 2023's Magi. There are certain things. But you got to be mindful of that. Once you enroll in Medicare, you got to be thinking, okay, what's my income going to look like? Did I inherit a big IRA that I can now only stretch over 10 years? Whatever the case may be, you got to be mindful of that. People are surprised by it. And a lot of times CPAs don't even catch it. So it's something I always think about when we're working on situations where we're trying to plan income, and that to make sure, okay, wait a minute, if we do this big conversion or whatever it is, we got to stay under these brackets if we don't want to have the income tax plus Aunt Irma visiting for 12 months. Right.
I want to repeat that because I know it's a lot of information. So for people listening and they're thinking about their Medicare premium, and if they're 63, they don't realize their Magi at age 63, if they're married joint filing, it impacts their premium when they turn 65. So how big is the range of premium?
It is, so I'm going to look at it. It's 5. So it can go up to the standard Part B premium this year is $174.70.
Okay.
But if you get to so if you get to the top, so if you had income over greater than $750,000. Now, this is for married couples. It can go up to $594 per month. If you have 2 people on it, it's double, right? It's double that. So it's a premium band. But let's say that you did a big Roth conversion and you went up, the married. So if you have AGI under $206,000 or less as a married couple, you're fine. But if you have $206,001, you're in the next brand. So it's a cliff regime, right? And then instead of paying $174.70, you pay $244.60. So it continues to go up for each band. So you just have to be mindful of that. Yeah. And so, and Magi is before deductions, right?
Yes.
So if it's not, oh, well, I've got my standard deduction. It's not before your standard deduction. So you just have to be careful of that when you're doing planning. Now, if it happens to you 1 year, just know that the next year it's they can use the next year's AGI or MAGI. So it only hits you for 1 year if it goes back to normal levels.
If two people, and we're huge proponents of doing Roth conversions and paying Uncle Sam now and paying for taxes when they're on sale.
Right.
But if you're above the age of 63, you have to think about this because it is going to affect your Medicare premium. So if you convert $200,000 from an IRA to a Roth IRA, that's all being added into your earned income. Your Medicare premiums are going to go up, and then you might be paying that times two. So just make sure.
Yeah, you got to think about, but down the road, what do these IRAs look like? Let's say I have IRAs, they're going to have huge RMDs down the road. Am I going to be paying this year over year because my RMDs are going to be so high? See, that's why you have to work with someone that understands. Am I going to pay it now to lower the risk of these RMDs, making me have to pay it year over year? That's why you have to work with someone that kind of can help you navigate what's the best avenue to take.
Very good. And we are retirement income certified professionals, so call us anytime at 866-780-SAFE. That's 866-780-7233. If you want a copy of our free information or a free consultation, or if you want to read a copy of one of our books, just give us a call, 866-780-7233. Okay, now we're getting into the later part, even though it doesn't seem like it's the later part, but hey, we've already covered age 50, age 55, age 59 and a half, age 60, age 62, age 63. Now we're getting to the fun part. We turn 65. It's a landmark age for most people, not all people. But Heather, what happens when people turn age 65 regarding their retirement years?
So that's the big age for enrolling in Medicare. Now, not everyone enrolls in Medicare, but if you do not have creditable coverage, and creditable coverage means that you are working for an employer that has 20 or more employees. If you're working for a small business that doesn't, that is not considered creditable coverage. So you have to make sure with your employer who pays first, right? So I would always, if you're not certain, go to your employer because you do not want to miss your initial enrollment period, which runs 3 months before your 65th birthday, the month of your 65th birthday, and 3 months after. Okay, so you've got a 7-month initial enrollment period. If you fail to enroll during that time, you could be paying lifelong late enrollment penalties for Part B and Part D. So you don't want to miss that. Now, I will tell you a couple things, that if you're already on Social Security at that point, you will automatically be enrolled in Part A and Part B. And some people will say, well, wait a minute, I don't want to be enrolled in Part A or Part B because I do get my coverage and I want to keep my coverage with my employer. You can disenroll in Part B, but not Part A. Why this is important is because if you are contributing to a health savings account, so let's say you say, well, I have great coverage. I don't want to pay for Part B because I have good coverage over here. You can disenroll, but if you have a health savings account, you must stop contributing because once you are enrolled at any part of Medicare, Part A included, you must stop contributing to it. You can use the funds at that point that you've saved, and hopefully you have been max funding that health savings account, which you can only use if you have a high deductible health plan. But you can use the funds, but you cannot contribute. So that's what I'll say there. Now, if you have creditable coverage, COBRA is not creditable coverage, retiree coverage is not. If you work for a small employer with less than 20 employees, you must enroll. But if you do have creditable coverage, then you have a special enrollment period that runs 8 months after you lose that coverage. So, but 65, a really important year. Medicare.gov has a tool to help you navigate what your choices are. I would do that long before you turn 65, just kind of figure out what your options are in terms of traditional Medicare or Medicare Advantage plan.
Very good. And we handle all sides of this in our financial planning here. So the beauty to being once 3 generations, my father passed about 18 months ago, but we had my father, myself, and my son. My son is a retirement income certified professional. I'm a retirement income certified professional. We handle not only the financial planning, the insurance side, life insurance, annuities, income riders, income planning, but also the Medicare side. So I know we were talking just this week, and just in 2024, we have over 80 of our clients turning 65, right? This is peak 65 year. More people are
we
turning
didn't talk
65
about that
right now than any other time in history. And we have over 80 who are just our clients. So if you're listening right now, you don't have a specialist to go to. You don't want to go do this to someone who just kind of does it a little bit here and there. You want to go talk to someone who's doing this every single day. So call us anytime. And you're learning why we have Heather Schreiber on the show as often as we possibly can. I think this is her 4th or 5th time, because she knows this stuff more than anyone in the world, in my opinion. That's why my motto has always been, I don't have to know it all, because I know the people who do know it all. And that's why she's on the show. So Heather, thank you so much. Let's transition from age 65, which is a big one, to another one, which is a new big one, age 67. What happens at 67?
Yeah. So we've transitioned over the years from age 65 being the full retirement age to age 66. And then we kind of went through this 66 plus 2, 4, 6, 8, 10 to now 67 being the full retirement age for those born in 1960 or later. The jury's out as to whether that will increase because of the insolvency issues facing Social Security. But for now, individuals born in 1960 or later have a full retirement age of 67. Why it's critical to understand when yours is based upon your date of birth. The only caveat I'll give is if you were born on January 1st of the year, you look to the prior year to determine your full retirement age. But the magic happens at full retirement age. A couple things. You get 100% of your primary insurance amount. Your primary insurance amount is based on your highest 35 years of indexed earnings that you've had over your working career. You also no longer have to worry about the earnings limitation. It goes away. So you could work to your heart's desire and still collect a benefit and not worry about a pullback of your benefits because of it. So a lot of happens there. I would say, with people living and working longer, particularly living longer, getting to that age, I would say, okay, that's better than nothing, right? Filing at 62, I would usually not encourage. So that's a magic age. Getting to that point is good. It's also if you're a dependent spouse, that's when you would get the full 50% spousal benefit. So a lot of good things happen at that age. So that's a critical one. Make sure, again, not everyone is born in 1960 or later. You have to look to your year of birth. And if you're January 1st, like my grandfather was, then he would go the year before. So a critical age, and really working with someone that understands Social Security filing, timing, looking at everything you have. And it's not just looking at break evens. I could go into a whole segment about why you shouldn't just look at that. You got to look at everything else. What other sources of income you have, the type of income it is, how is it going to be taxed? How is it going to affect Social Security taxation? Age is just one part of that. So that's all I'll say about that.
And let's squeeze in one more age, because I would have forgotten it. You're saying that reminds me, of course, age 70, before we get to 70 and a half. Age 70 is a critical age. Why is that?
Age 70 is the latest age to claim Social Security benefits, and please don't delay beyond 70. And I hear cases all the time where people say, well, I'm 73 and I never did it. I'm like, please don't do that. I mean, although the trust funds desperately need your dollars, they don't give you any brownie points for waiting till 73. You must file at 70. If you fail to file at 70, then you can ask only for 6 months of retroactive benefits. Is filing at 70 great? Yes, it is, because you collect 2/3 of 1% for every month of delay beyond your full retirement age month. So that's where you hear this 8% per year. Those are called delayed retirement credits. You earn them on a monthly basis, okay? It's not compounded, but you earn it on a monthly basis, which means you don't have to wait a full 12 months to get it. The way they give it to you is a little bit odd, which is a whole other subject, but you could wait 6 months and earn the 4%. So people always ask, do I have to wait the full 12 months? No, you don't. You can wait a certain number of months and get those delayed retirement credits, but don't wait beyond 70, please. And if you've done that situation where I was talking about earlier, where you file for survivor benefits intending to switch over to your own retirement benefits, you have to make the call to switch. It doesn't automatically happen. So make sure that you do that as well.
Very good. And I'll just say this, and Heather does such a beautiful job of sharing all this information with us, but so much of the time people will call in and they'll say, Brad, I already have Social Security figured out. I'm triggering at 62, and I'm going to let my 401k continue growing, but I'm starting that Social Security. And one of the things I will say is you better think about that for lots of reasons. Are you married? What were your two income amounts? What about the future planning of what if one spouse dies, losing the lower, retaining the higher? But beyond all that, It's this 8% roll-up that she's talking about. When you're comparing your Social Security benefit at 62, which is permanently reduced if you choose that, versus leaving something in a 401k or an investment, here's the whole key. Is the investment or the 401k guaranteed to roll up at 8% every year while you're doing that? Because your Social Security is. So it may be that you need to do some different planning with talking with someone who understands all the different options there are there. So,
well, plus cost of living adjustments, Brad. Think about that.
Absolutely. Cost of living
adjustments. Think about the year we had 5.9%, so plus cost of living adjustments. So that
much goes into whether or not you trigger at 62 all the way up to age 70. And here's the thing, life changes during all those years. So maybe what we're planning to do changes because there's a death of a spouse or you lose a job or something changes. So it's key to work with someone who knows what your options are, whether or not you maybe could change a decision once you've made it. There are exceptions where you can. So there's just so much that goes into it. And for time, we've got one more segment here. We appreciate you staying with us. We're going to talk about some key things that happen after the age of 70. But if you need information or you need help, you want a free consultation, just remember you can call us anytime at 866-780-SAFE. That's 866-780-7233. And there's always someone standing by to take your call. Okay, now we're going to try our best to squeeze in one more episode here. I know we're getting short on time, but we've got 3 key retirement planning ages left, 70 and a half, 73, and 75. Let's start at 70 and a half. It used to be a key age because that was the deemed required minimum distribution age, not anymore. Now there's something else that we focus 70 and a half on, Heather, so talk to us about that.
Yeah, so back in the day when RMDs began at 70 and a half, that was when qualified charitable distributions began. And believe it or not, I think they've been around since don't quote me the year, I think it was 2016. They have actually been around. In fact, they were supposed to expire and then they got extended. And then they would expire and then they got extended until finally they were made permanent. Qualified charitable distributions are the best thing since sliced bread that
Amen.
Anyone who has an IRA that is charitably inclined. So think of yourself, if you are routinely tithing at your church or you're donating to some charitable cause at 70 and a half, if you have an IRA, you should consider pivoting and using the QCD strategy because it allows you to contribute up to $100,000 a year. It is indexed this year. I think it's $105,000 from your IRA. So if you're married and you both have IRAs, you can each do it. You have to move the money directly from your IRA to the qualified charity. So some custodians will directly send it to the charity. Some will make the check payable to the charity that you told them to make it to and send the check to you. And then it's your responsibility to get it to the charity and get the proper receipt. But the beauty of it is you can do is, again, up to the $100,000, $105,000, and then it is tax-free. So you might know that hardly anyone is itemizing anymore because the standard deductions under the tax cuts, the ones that are getting ready to expire, like Brad says that were on sale until the end of 2025. Right. No one's really itemizing. Very few people. I think it's 5% of taxpayers, and so that means that hardly anyone's getting to take advantage of their charitable donations. And so this is a way to, without itemizing, being able to take advantage of a tax-free situation. So you take a qualified charitable distribution, it's not only not, you don't have to deduct it, it's tax-free and it goes to the charity. So you're taking advantage of something that you otherwise wouldn't be able to take advantage of if you're not itemizing your deductions. Fast forward to the point at which you get to RMD age, and now it's a double whammy because now not only is it tax-free, but it also can satisfy all or a portion of your RMD. That's huge. So this is a huge way. Go back to where I was talking about if you have RMDs that are going to push you up into a higher tax bracket, push you up into Medicare surcharge territory. This is the first thing you should do to bump your AGI back down. So if you have large RMDs, you are routinely donating to charity, pivot to this QCD strategy because not only can you satisfy, I said, all or a portion. If you have $150,000 RMD, well, you know that you can do $100,000 of it to offset the RMD. $50,000 you would still have to take. to get rid of $100,000 of your taxable income. It's a huge opportunity. I tell every financial professional that I work with, hey, make sure that starting, at 70, you're reminding clients about this, so they can start doing it at 70 and a half when they can get to the age at which they're subject to RMDs. It's only from IRAs at this point. We thought it might switch to be available to 401ks and other qualified plans. It's still not, but it's a huge tool to use.
Well, let's do this. Let's blend the age 70 and a half and 72 and 73 kind of together, because this is flowing really well. And again, we're about to run out of time. So here's the thing. Yeah, I know it's so confusing. The first RMD age that we knew forever was 70 and a half. Then for a short period of time, it moved down to 72.
72.
And now it's at 73. But here's where the RMD and the QCD blend together beautifully, like Heather was saying. I cannot believe that financial professionals don't talk to their clients about qualified charitable distributions. When you think about it, you get to take a tax deduction on the front end when you put the money into the retirement plan. Then you get to take it back out and give it to your church or your charity on the back end, and leave Uncle Sam on the bench completely when you do it the right way. You got to get over the old school thinking of, well, I need to write a check and see everyone watch me put it in the plate. And anymore, it's not that way anyway. We all give on our phones and that sort of thing. But there's a much better way to do it. If you've reached age 70 and a half and you're working with a qualified financial professional and a willing custodian, it has to be a willing custodian. They have to be willing to cut the check directly to the custodian, to your charity of choice, and be able to do that. Now, we do that for all of our clients. You tell us what QCD you want to take. We will work with the custodian to get the check made to the charity. Most of the cases, it's got to go to you, and you have to deliver it, but you are finding a way to give that money and never have a taxable event take place. But here's the key thing, and I know Heather can talk about this. You got to be very careful once you hit age 73, which is our next age, now the required minimum distribution. Don't get trapped in your mind into thinking, well, my RMD for this year is $5,000. So I'm going to take that right off the bat in January. And then later in the year, I'm going to do my QCD. You can't do that.
You can't undo it, right?
The first dollars out of an IRA are deemed the RMD. So I tell everyone, if you're going to use a QCD, do it at the beginning of the year and make sure you make that gift, because that QCD will satisfy the RMD, but you can't reverse it. You can't take the RMD first and then give a QCD later. It will be taxable because you've already done the RMD. Is that correct, Heather?
That's right. You can't undo it and say, oopsie, I meant that $5,000 to count toward a QCD. You can't undo that. So you always want to make sure, because a lot of people have their RMD set on auto pay, right? So you want to undo that in a year that you want to do a QCD, to make sure that you do the QCD. You stop the auto payment of an RMD, because the auto payment is going to come to you. So make sure that you do that and I think most custodians, they can't deny a QCD as far as I know. And make sure too that when you do your taxes, if you have a tax preparer, make sure that you tell them that you did a QCD, because there's a certain way to there's instructions. It's not hard, but there's instructions on how to properly account for the fact that you did a QCD on your tax return. But yeah, like Brad said, it is a game changer to me for anyone who's trying to lower their tax liability once they reach that 70 and a half age. And then once they reach, 73. So yeah, we had, a year and a half or so of having 72 as the RMD age. And then the Secure 2.0, increased it to 73 for people born between 1951 and 59. And then those born in 1960 or later can further push it out to age 75. Is that a good thing? That's a nod to people who are living longer. For some, it can be good. But again, the longer you wait, the higher balances are going to be, the bigger the RMDs are going to be. So you really have to work with someone that can help you figure out, is that a good plan? Or is it better to perhaps live earlier on your pre-tax qualified plan balances and perhaps hold out on Social Security or something like that? You really just have to look at what makes most sense for you. So, I think we hit them all.
That's it. And if you missed that, that's what she was saying. If you're born in 1960 or later, even though the age is 73 for RMDs now, it's already been deemed that it's going to be age 75 if you're born in 1960 or later. So
by the time our kids are that age, they'll be 85. Who knows?
It will be, because here's what Ed Slott always says, our good friend and our mentor. You can be certain of one thing. Anytime Congress meets, there will be changes.
That's right.
And that's why you want to tune into a show like this, to hear experts like Heather Schreiber, because we're constantly staying on top of all the things that you need to know, key dates, key ages regarding your retirement planning. So I know we're out of time. Thank you so much for listening. Heather, thank you so much again for being with us on the show.
You're welcome. It's so fun always.
And if you want Heather's information, make sure that you go to YouTube, go to the podcast. Her information will be located there under the videos. So you guys have a great day. Thank you for joining us, and we'll see you next week, same time, same place. Have a great week.